Hi there, this is Dan Ferris. I'm the editor of Extreme Value, which is a value investing newsletter published by Stansberry Research. And you can find more about that at www.stansberryresearch.com. If you're interested in subscribing to Extreme Value, you can find that information at extremevalueoffer.com. Just remember, we don't do refunds. And today's video is inspired by the latest issue of Extreme Value, the June 2018 issue. And I just want to tell you a little bit about what's in there because I think it's too important to kind of keep to ourselves and not tell the whole world. Don't worry, if you're a subscriber, I'm not going to give away everything, but there are a couple real important general points to be made. Now, the first of these points is simply the title of the June issue, which is Risk Happens Fast. And I've tried to make this point many different ways, and I'll continue to try to make it many different ways for as long as I think it's relevant. Risk happens fast means that when you're in a risky trade, it can go fast, it can go wrong, oftentimes faster than you can get out. And a good example of this was the short VIX trade. Now, I started warning people about this back in September 2017, and I did it in I think it was the September issue of Extreme Value, and I did it in a presentation in Las Vegas at the Stansberry conference. And basically the trade was to short securities, exchange-traded funds and exchange-traded notes that were long the VIX, the volatility index traded on the Chicago board, quoted on the Chicago Board Options Exchange. It's not traded because the VIX does not trade. It's just an index of option prices. And the VIX is widely known as the fear index. When the market drops quickly, the VIX spikes up quickly. And with volatility, with the market going up and volatility falling since about 2012 or so, it just looked like a no-brainer. It looked like an easy peasy trade just to keep shorting these VIX securities on the public exchanges, the exchange-traded products. And one thing I will say is that those products are garbage. They're set up to deteriorate in value. They own the front 2 months of the VIX futures, which themselves are terrible securities. You know, when the VIX goes up 200 or 300%, the front month VIX futures contract doesn't go up nearly that much. So they don't really trade well enough to, do you a lot of good. And I know because I've traded them and they don't do very well at all. So the products are definitely set up to deteriorate in value, but they can still crush you if you're on the wrong side of shorting them. And I told people, and I started warning people that that's exactly what would happen. It looked like easy money right up into the minute it would just mow you down and ruin you. And unfortunately, February 5th, that's exactly what happened. One of these big funds, the one with the ticker symbol XIV, which was a short VIX fund that people like to buy, from September to February, it looked like I was wrong and the thing just kept going up. But then all of a sudden, in a few minutes after hours on February the 5th, it dropped 80 or 85% just in minutes. There was no way you could have gotten out. Everything you had in it was, 85% of everything you had in it was gone instantly, virtually instantly. And of course, a few weeks later, they shut it down and the XIV does not trade anymore. That's what I mean by risk happens fast. And the examples are not isolated to risky, weird securities like that. They're in bonds and stocks, and they're all around you. And bizarrely, they are in some of the things that are supposed to be the very safest investments. Things like sovereign debt. Anybody who had a lot of Italy bonds, and there are, a couple trillion of them outstanding, or more than a trillion anyway, they got a really rude awakening recently. Bill Gross, the bond king, the best bond trader in history, he was down 3% in one day when Italy bonds were down just very suddenly 5%. 5% is a huge, 2 or 3 day move. for a sovereign debt instrument of one of the largest economies in the world. These things are supposed to be the safest investments, not the ones that fall apart instantly. And of course, that happened during the financial crisis. The U.S. 30-year mortgage was, the envy of the world as far as safe yield was concerned. And Wall Street turns it into toxic waste, and you know what happened next. So risk happens fast. If you're in a risky trade, the answer is not to promise yourself you'll get out at the first sign of trouble, because that could very well be way too late. The answer is to sell now and get out before any signs of trouble. And yes, give up whatever you think the upside is. Everybody who got out in September 2017, who exited the short VIX trade, probably thought I was stupid for 5 months, until the minute that everyone who was still in it was ruined. And then all of a sudden, I was right. And the thing is, this is not to toot my own horn, but the point is, I was right the whole time about the risk. You understand? I was right about the nature of the risk the whole time. When it actually blew up, when, or even sometimes if it actually blows up, that is not the point at all. The point is to understand the risk you're exposed to. And I just don't think, I have several examples in the June issue of bonds and things that just went wrong in a really fast period of time. Didn't give people a chance to get out. And I think there's a lot of stuff like that in the world. And, even the U.S. stock market, it's not going to go bad in, 5 minutes after hours trading like the XIV, but it can go bad quickly enough to really punish you with a big loss before you even know what to do about it. And the answer is to have plenty of cash on hand. If you have all your money in stocks and no cash, then, the market falls 30 or 50%, you're not ready for it. And I realize these things are extremely rare. And you won't hear me talking about the entire stock market, the S&P 500 or the NASDAQ or the big indexes falling like this very often at all. In fact, 99% of the time, you shouldn't even think about it. But when stocks are pushing up against all-time highs and Amazon is trading at, 50 or 55 times all the profit it's ever earned since founding, that's probably the time to think about that sort of thing. And Facebook taught us that you can be in one of these big, safe, wonderful, do no wrong businesses and lose 20% of your money just like that. Now, of course, it's recovered, and all of those stocks are making new highs, but that's another point that we make in the June issue. Fear is not to be feared. Euphoria is to be feared. When everything starts making new highs again and you know that it's way too expensive, that's the time to be afraid. And as I said back in September, you can lose a lot of money in Facebook and Amazon and Google and all these things really fast. And we showed the example of Cisco in a previous video. And then there are more current and important examples, I think, in the current issue of Extreme Value. So that's like a major, major, major point. What we also do in the June issue is we show you a very specific broken down example strictly from a value investor's long-term view, what I believe is going on in the market when you see it fall 5 or 10% very quickly. It fell 10% in 9 trading sessions earlier this year. And I explain in some detail, in some technical detail, exactly what is happening and why those losses happen so quickly. It's basically the market correcting a mistake, and I show you exactly what that mistake is and give you like specific numbers and everything. So that's another thing that we do in the June issue. We break that example of Amazon down very quickly and show you why we think a 50% or 30 or 50 or huge loss quickly in Amazon is likely at some point here. And why a value investor simply can't buy Amazon today. And finally, what we do in the Extreme Value June issue is we deal with the subject of EBITDA. EBITDA means earnings before interest, taxes, depreciation, and amortization. And specifically, Charlie Munger and Warren Buffett, the guys who run Berkshire Hathaway, They have a lot of problems with EBITDA. They think it's a terrible number. Charlie Munger refers to it as BS earnings. He's allowed to use the full term there. I'm only allowed to use the the initials on this video because it's a product of Stansberry Research. Um, but yeah, EBITDA is just a number, and I explain in the issue in some detail exactly why it's okay to use that number in some circumstances, and the circumstances under which you should be highly, highly suspicious of it. And there's a pretty decent article about it, which I did not mention in the June issue, by Jason Zweig. Recently put out an article, or he recently tweeted it. I don't know if it's an old article, but it's there's a good article in the Wall Street Journal by Jason Zweig about all the different forms of EBITDA that are used and frankly abused. And the real point is that as long as you understand what the components of that number are, you will understand when and if it ought to be okay to use it. And that's what an investor needs to do. It's nice to listen to Charlie Munger and say, EBIT is crap and you should never listen to it and you should never use it and anybody who uses it is wrong. Well, okay, but that's a very general statement, and he's a very, actually, kind of a showman, just like Warren Buffett in his own unique way. He's a different type of showman, and he's always trying to make a splash and make an impact. So you have to keep that in mind. Um, and you need to think for yourself and analyze for yourself exactly what this number is and when it ought to be used. So that's just a little taste of what we covered. There's a lot more detail in the report itself. And, to extreme value readers, I hope you take a look at it, because the warnings that we have in there and the very specific nature of them, I think, is important to understand right now. It's important to understand why I think you can suffer big, fast losses when the market gets this expensive, and how you protect yourself from them, which is something I've shared with the world for quite a while now. Hold lots of cash, only buy stocks when you have a sufficient margin of safety, and don't be afraid now and then to short the shares of deteriorating businesses in difficult industries. And that's all I have for you today. And I'll have some more in the coming days. I have a few more things on my mind. So I'll talk to you again very soon. Thanks.